Welcome back to another video. Today we got an interesting one. We got a question that many people never think to ask in their life, and that is, what is a dividend? What a dividend is very important to understanding financial independence. It's very important to your freedom. It's very important to your retirement if you plan to do that, which I think that everybody should plan to at least have the freedom to be able to retire, even if you plan to work until the day that you die, which a lot of people do. I might be one of those people. But anyways, what is a dividend? It's very important to understanding the actual stock market, why it is important, why business is important, why business conditions are important, and why dividends and the stock market in general are not just a tool of the rich for the rich by the rich, and why you can benefit from them as well. So before we get into what a dividend is, we need to establish what a stock is. A stock is essentially a share that you can own within a company. It's a piece of that company. So let's say that there's 1 million shares, which there's not, of Apple, and they're worth $1 trillion. If you own one share of that company, you own 1/1,000,000th of Apple. So that sounds pretty good, right? You know how much they sell on iPhones, how much money they make, how much profit they make. You would want some of those profits. And that is where we get to what a dividend is. A dividend is the company deciding with their board of directors and saying, hey, we're going to give some of that money back to our shareholders. We're going to let them have some of the profits of the company. So that goes with any company. That goes with private companies or publicly traded companies. The way that companies give the money back that they make is through dividends, through distributions, and things of that nature. One thing that's really great about dividends is that when we try to do our little calculation, go up to somebody, if you ask them, hey, how much do you need to retire? What they're going to try to figure out is how much money do they spend per year and how many years are they going to be in retirement? So they'll try to figure out essentially, what do I spend every year and how many years am I going to live? But unfortunately, we do not know how many years we're going to live. So the better thing to do is to generate that amount of income from dividends, from rent, and just through actual cash that your portfolio generates. So a dividend can be a way that instead of saying I'm going to sell a portion of my portfolio every year, or I'm going to sell the houses that I own when I go to retire, you just collect the rents, you collect the dividends. The next thing I wanted to get into is retirement is a number, not an age. You could retire at 29, you could retire at 65, you could retire at 85, you could retire at 30. It doesn't matter. Retirement is a number, not an age. Typically, people will use the 4% rule, or in other words, 25 times what you spend per year is what people will use as far as what they need their portfolio to produce. So let's say that I spend $10,000 per year. That means that I could retire off of $250,000, which is not the case, but I was just making an easy example. So same thing, $40,000, I could make it off of $1 million. Now, obviously that's oversimplifying the tax situation, but you get the point. Okay, how often is it paid out? A dividend is paid out typically quarterly, monthly, semi-annually, or it could be paid out just annually. Most often it is paid out quarterly. Then after that, I would say it's monthly. Some companies like Disney pay out semi-annually, and other companies pay out either annually or irregularly. They just pay it whenever they feel like paying it. Next thing I want to talk about is dividend safety. So dividend safety is actually very intuitive, and dividend payout ratios, they're very intuitive when you actually just break down what they are. So basically, a company makes a certain amount of profit. Let's say my company makes $100 in profit per year. If I paid out $60, I have a 60% payout ratio, or $60 of the $100 is what I pay out in dividends. So 60% payout ratio, you generally don't want to see payout ratios above 75%. And the reason is because if profits were to take a dip by say 25%, now I'm only making 75% of what I used to make. Now I'm unable to pay out my dividend. So dividends that are under 50% is generally what I try to go for, depending on the company and depending on the growth of that industry and that company. So for cigarette companies, maybe it's a little higher, but for companies like Apple, companies that are growing, maybe they want to plow some more of their money back into their business. Anyways, do dividends matter? This is a big question out there. Do dividends actually matter? Because there's a thing called the dividends irrelevance theory, which says that with the announcement of a dividend payout, there's generally an accompaniment of a proportional increase or decrease in the company's stock price. So if the company's stock price is just going to go down by the amount that's paid out, or it's going to go up if they decide to cut it, or whatever, if basically you're going to get a net zero return on that dividend, what's the point of it? Well, there is a point of it, and I'm going to get into that right now. I think that they do matter because, for one, the announcements of a company to pay a dividend aren't the only thing. It's not in isolation. You know, they could also announce that they had really high earnings. So it's not necessarily, you know, if they announce a dividend, their company's stock price is going to go down. Also, the markets are not necessarily rational, as we've seen this year. The economy has been going down and the markets have been going up. So let's talk about when to buy dividend stock and how to get paid dividends. So the ex-dividend date is the date which you have to own it before. So you can't buy on the ex-dividend date. Let's say that it was December 20th. I'm recording this on the 19th, but let's say it's December 20th and that's the ex-dividend date. If you buy on the 20th, you will not receive the next dividend. If you bought today on the 19th, as I'm recording this, and the ex-dividend date is on the 20th, you would receive the dividend. So that is what the ex-dividend date. The record date is when people who are entitled to the dividend are decided, and the payout date is when the dividend is paid. And it looks like in my notes I'm going back really quick. So I said 6 to 7% is generally a red flag. So if you see a dividend that's paying out a really high percentage, that's generally because the company is being discounted by the market, or in other words, the market does not want to pay that much for this company because they know that the dividend is subject to be cut. So 3-4% is pretty high. 2% is normal. Right now, I believe the average for the S&P is around 1 point something. It's like 1.3-ish. So anything above 2-3%, the market is basically discounting that stock for whatever reason. Either it's not growing, they might think the dividend is going to be cut, but you have to look into that and don't just chase yield, because if you chase yield, you might get burned, as I did. I got burned by a couple companies that cut their dividend, including CenturyLink, which was a really bad move. It was like 12% dividend, and after they cut, it was about a 3% dividend. So that's what the market was pricing in, and I was a newbie, didn't understand that. So back to, do dividends matter? I would say yes, because for one, they prop up the stock price. So when they pay out a dividend, essentially people are willing to invest in that company because they know that they have a stream of cash that's coming in. Number two, it gives the management team bills. So if they know that they have to pay out these dividends, they know that they have to make a certain amount of earnings, they have to cut costs, they have to make sure that they are actually making a profit every year, they have to make sure that they are servicing the shareholder. If they know that they have a dividend, they know that their stock is being propped up by this dividend. I think it just shows a different type of company. It shows that it's a sign that the company is a good profit-making machine. It's awarding its shareholders, and it's usually a company that is more established, has been making a profit for a while. On the negative side, it can be a sign that the company is not growing. If they're paying out most of their profits in dividends, or a good portion of it, it means that they don't have very many places to invest their money to make the actual company itself grow. And the last thing, on the good side, once again, you can fake accounting, but you cannot fake a dividend. So just a couple last little things. Dividend yields. Dividend yields are based upon the price of the stock, and the dividend yield is set by the amount, not the percentage of the price. So basically what I mean by that is that, let's say that we bought a stock for $2 and it's paying out a dividend of 50 cents per year. The dividend yield on that is 25%, right? If the stock price goes down to $1, now the dividend yield is 50%. Obviously, these are ridiculous numbers, but the point being that they don't pay out a percentage of their stock price. The percentage of the stock price is just how we calculate the yield. It has nothing to do with the dividend that they pay out. This is a big mistake that I made when I was starting. I thought that if the price went up, oh man, they're going to pay out more money. No, it's based on how much they're paying out. It's not based on the stock price. So yield on cost is the last thing I want to go over. Let's say that we have that same situation. We got a $2 stock paying out 50 cents a year. We got a 25% dividend yield. Let's say that the stock goes up to $5 and they start paying out $1. Well, we still paid $2 for the stock. So our yield on cost, or yield on what we paid, is going to be 50%, right? Because we paid $2, it's paying out $1. That's 50% based on what we paid. So over time, what you see is a big yield on cost on these dividend stocks, especially stocks like Coca-Cola, stocks that are dividend aristocrats or dividend kings, which means they've been paying out for 25 years and 50 years respectively. So that's how you get huge compounding growth. Eventually, some people are making on their old shares as much as they paid for it every quarter. So anyways, hopefully you guys like this video. Dividends, they are not get rich quick, but it is a good strategy. It's a good way to start building out your legacy. This is something that you can give to your kids. They can own some Coca-Cola stock that grandpa, great grandpa bought for them, and it's a great way to start building that generational wealth. So anyways, I hope that you guys enjoyed this video. You guys understand a little bit more about the wealthy, about dividends, and hit that like button if you did. Join the Facebook if you haven't already, and I'll see you guys in the next video.